Good afternoon, everyone, and a big welcome to this session on discussing the autumn budget with NIESR and colleagues from both PGIM and the CBI. I'm Tera Allas. I'm a senior advisor at McKinsey, but also a previous trustee of NIESR and continue to be a governor at NIESR. And I'm absolutely delighted to be chairing this session today to discuss what has been a very eventful budget and run up to budget. And it's nice to have it finally out there and to be able to start digesting what it actually means for the economy, for businesses up and down the country, as well as families and individuals. I'm sure, like you, like me, you've all been watching the news and listening to the commentary. I'm really pleased to welcome our panel today because I think we have an absolutely stellar panel with also a complementarity of perspectives. So we have Katharine Neiss from PGIM, who's the Chief European Economist there, and she will give us her reactions to the budget, but also a bit of commentary around how it's gone down with the markets, which obviously are very important in continuing to maintain confidence in the UK economy and keep borrowing costs as down as they can be. We then have Stephen Millard, the NIESR Deputy Director for Macroeconomic Modelling, and he will comment on NIESR's initial analysis of the impact of the budget on the macroeconomy and also some of the issues around how the government has been handling these fiscal events. And last but not least, we have Mohammad Jamei from the CBI. And with businesses ultimately being the engines of growth for the UK economy, it'll be very important to hear what the business perspective on this budget has been and how businesses are reacting to it. So very much looking forward to all of their contributions. We will have time for questions and answers once our panelists have spoken in the beginning. And so I encourage you to put your questions into the chat function. And depending on how many questions we get, I might either ask you to repeat your question live, unmute yourself and then mention your question. Or if there are quite a lot of questions, I might summarize them and just ask our panelists to comment on them on that basis. Our panelists are basically in their first kind of 5 minutes or so each going to talk about their highlights and their lowlights of the budget. And then we will move into more of a discussion with follow-up questions and questions from you in the audience. So without further ado, let me hand over to Katharine, the Chief European Economist at PGIM.
Great, thank you, and thanks to NIESR for inviting me. I can hardly believe this day has finally arrived. Feels like we've been looking forward to it for a long time. So let me just, give a few kind of high-level points around, how this market has sort of landed with a focus from the market's perspective. I think the first thing is that there were no real major surprises in this budget. To the extent that there was a surprise, it was actually that even pre-measures, there wasn't a big fiscal hole, which was the kind of things that were being trailed beforehand. If anything, actually the starting position for the government probably was looking a little bit more favorable than what you might have expected given the headlines. So, markets don't like surprises. They like certainty. So it definitely ticked that box. There was also enough in there, I think, from a market's perspective that seemed to satisfy the Labour Party. And again, I think that's a positive from a market's perspective because there was, again, a bit of headlines in the run-up to this that there would be some rebellion, some divisions within the party that could see shift more to the left, which is a more spending, focused government that, markets could potentially react to. So seems to be a budget that is going to be acceptable to MPs, Labour MPs for now. It also builds in more headroom. That means that the chancellor has a bit more of a buffer when it comes to, data outturns, maybe looking a little bit different to what is baked into these projections. There was nothing, obviously anti-growth in this budget, which again is something I think that markets were very focused on, especially on the back of the previous budget. And then finally, I think the final kind of good news from a market's perspective was that there wasn't anything obvious that would stand in the way of the Bank of England being able to deliver cuts to bank rate over the foreseeable future. So far, so good. What I would say, though, however, is that this position of fiscal fragility for the UK is still very much in place, and that has not been tackled in this budget. Some of the optimistic elements of the forecast have been, adjusted down, like on growth, but on nominal wages, those numbers look a little bit high if you think about how much slack there is. And that's important because if nominal wage growth is high, then you can imagine that the government can expect to have lots of tax receipts. So if that doesn't come to pass, then your tax receipts will be less. And so it still holds out this very likely possibility that the government will need to come back and look for other ways to raise revenues, i.e. higher taxes. Then, other elements, it's a very backloaded, that's quite typical for government budgets. The fiscal pain only comes, after the next couple of years. Most of the fiscal consolidation comes through tax rises, when I think markets would have liked to have seen more spending cuts. So really no kind of tough decisions were really taken in this budget. Very little on supply side or reforms, which seems to have kind of gone down a little bit in terms of the pecking order of priorities. So I think there was enough there to calm markets on the day, but this fiscal fragility with the UK sort of standing out as a bit of an outlier and therefore being vulnerable to markets, I don't think that's gone away. And a lot of it is a bit unfair because the UK actually doesn't look that bad if you look at some of the macro numbers. So you can ask yourself why. Why is the UK more vulnerable to shifts in market sentiment? Maybe that's something we can come back to a little bit later.
Thank you, Katharine, for such a succinct and extremely illuminating summary. I might actually ask you a quick follow-up question, which is your point about fiscal fragility is well made. How does that still is it still the case that markets see that fragility there and the uncertainty that it creates, even though the chancellor did increase the headroom quite significantly?
I think in a nutshell, yes. So the numbers do look better. This headroom essentially doubled. It doesn't look massively like an outlier if you look past over the last decade or so, but it's still on the low side. And if you were to just do kind of a simple analysis of the sorts of shocks that we could expect to see, because I think one thing we've learned over the last couple of years is things don't turn out the way we think they might, is very sensitive, is not enough to protect against, an unknown kind of shock. But over and above that, I think there are also just some fundamental features within the UK that make it more vulnerable, other things equal, than other countries. So it gets a little bit picked on, I think, in that regard when it comes to, the market can put more pressure on the UK than it can, for example, on France. And so that means that the bar is just got to be a little bit higher here. And I'm not sure that has been delivered in yesterday's budget.
Fascinating and really, really important. And if I may, I'll actually ask one other follow-on question, which is one of the negative consequences of a very long period of run-up to the budget was the constant speculation around what might or might not happen at the budget itself. Do you think that with the current package of measures, we've sort of now put that speculation to bed a little bit, and unless there's a big shock, and let's assume for now that there isn't for the time being, the there's actually going to be a bit less frantic speculation and a bit more just get on and deliver the measures you said type discussion in the next couple of fiscal rounds?
My gut is no. And I think one of the biggest puzzles from yesterday was the fact that actually the starting point looked pretty good, whereas the news beforehand was trailed as, suggesting there was going to be this big fiscal hole, and in fact talk about the potential of breaching a manifesto pledge around income tax. So I think there's really a question out there. Why did they do that? And again, this is, just a very markets, a narrow markets perspective. Was what were the motives behind doing that? It seems sort of odd to do something as politically, risky as breaching your manifesto pledge if you don't really have to. So the question was, why did they do that? And the reason why I think markets will be interested in knowing this question is, well, what does it mean for the future? If this vulnerability is still there, does that mean it's still on the table? What implications does that have for growth prospects? Markets tend to reward more spending cuts than tax rises, because generally those are seen as more credible ways of fiscally consolidating. So I think all that is still sort of there and a puzzle, and markets will be chewing over that, I think, over the next couple of weeks.
Thank you, Katharine. And we will probably come back to some of that in the Q&A as well, because it's such an important question, this stability and ability to kind of understand the political as well as the economic motivations behind the decisions. I would like to now move on to Stephen, who will give us an overview of NIESR's analysis of the macro impacts of the budget, and then we'll have a bit of a discussion about how we think this particular budget has gone down in terms of fiscal rounds, such as they are. So, Stephen.
Okay, thank you very much, Tara. I mean, Katharine has already made a few of the points that I was going to make, but I will repeat them anyway. The first one, though, is something that you said in the question, that in the run up to the budget, we had so many leaks and so many kites being flown and so much uncertainty around what was actually going to happen, that in and of itself, actually, I think, caused some economic damage. The sense is certainly that investment was put on hold in the run into the budget, particularly because of this uncertainty. And that ignores the issues raised by the Deputy Speaker in the Commons yesterday, reminding parliamentarians of both sides, it has to be said, that Parliament is supposed to hear the budget before the media. What about the budget, though, when we finally did get to hear it? Well, I think the thing that struck me about it, or struck, and indeed NIESR colleagues, was that we're left in a high tax, high debt world. There was no real attempt to bring the debt to GDP ratio down. Okay, the chancellor achieved her fiscal targets, but if you're going to reduce debt from 100 to 99% of GDP, that's not really tackling the issue of high debt. And now is the time to tackle it, because you know what? There will be a bad negative shock in the future, which will require the government to borrow very heavily and for debt to rise again. Much better to get debt down while you can, so that you have that extra room in the future to deal with the next bad shock. So that was our main fill. In terms of the fiscal rules themselves, this was the classic example of an Augustinian approach to public finance rectitude. All of the bulk of the tax increases, the bulk of the fiscal contraction is happening right towards the end of the Parliament. Now, in some senses, that's fine, that's okay. Maybe indeed that's a better time to do it. But given that will be just ahead of an election, it strikes me as very hard to believe that the government can credibly commit to keeping to a fiscal tightening at that stage. What else can we say? The headroom itself was doubled from 9.9 billion to 22 billion, actually slightly more than doubled. That still, I don't think, is enough. As Katharine mentioned, the OBR reckon there is now a 59% probability that the rule will hold. That's still not a particularly high probability when all is said and done, just slightly more than a coin toss. NIESR, we in our November outlook, we recommended a buffer of 30 billion, and we suggested that even that might be a little bit on the low side. So there is an issue there. The buffer is quite low. You could imagine a couple of negative shocks over the next few months, and again, we will have to come back to the uncertainty of what to do. Now, the Chancellor, this was one good thing I think about the budget yesterday, confirmed her commitment to one fiscal event a year, and she said very explicitly that she would not assess the fiscal rules in the spring. At the same time, Richard Hughes reminded us or stressed to us that the OBR would be doing a forecast in the spring. So we're not moving to one forecast year. We're going to keep two forecasts, but one fiscal event. Of course, the issue is what will happen if that forecast that comes out in the spring suggests that the government is missing its fiscal rules again? The result, I think, will either be an awful lot of uncertainty for another 6 months of the year, or the Chancellor may well be forced to come back with some actual tax and/or spending changes in the spring. Neither of those outcomes would be particularly good. Both of those, or the probability of both of those outcomes, is still relatively high. So more headroom, a serious attempt to actually reduce debt. That's what we would have liked to have seen. Unfortunately, neither of those things happened.
Thank you, Stephen. And perhaps I can follow up with a short question around, yes, it would have been nice to see the debt coming down sooner and more. As you say, you should fix the roof while the sun is shining. It's relatively shining at the moment anyway, relative to some big shock we might face in the near future or even in the medium-term future. But how, like from a NIESR's analysis perspective, what were some of the missed opportunities in terms of bringing that deficit down and reducing debt?
Well, I think the quick answer is there's no easy way of doing it. But that doesn't mean to say you shouldn't. We would have suggested a rise in the basic rate of income tax, in the higher rates of income tax. This is a particularly efficient way of raising tax revenue. It causes the least amount of distortion to the economy. It's certainly better than the whole heap of small tax increases that we saw, which I'm sure Mohammed will come back to in his talk. But and also to look at spending. The welfare bill, they attempted to tackle that earlier in the year, and unfortunately it led to a backbench rebellion. It's those kinds of tough decisions that need to be made, and for political reasons, fundamentally, they were not.
Indeed, and you'd normally expect those tough decisions to be made early on in the parliament because you can still afford to take that hit on your political capital. As both of you have highlighted, the risk increases that whatever you've penciled in for the fourth or fifth year of the budget in terms of fiscal consolidation then becomes very unattractive to actually deliver, and that must be a remaining risk with this one. I wanted to ask you one more question, Stephen, before we move on, which is from a kind of macro assessment perspective. Katharine's mentioned some of the kind of positive surprises around the OBR's forecast. We all knew/anticipated the productivity growth downgrade. We sort of knew, but didn't know the quantity of the uprating or the better outlook on wages and inflation. What's your sense? Do we think the current OBR forecast is still a bit too optimistic, and might they have to downgrade that at some point anyway?
Well, personally, I still think it is a little bit too optimistic. In terms of their productivity growth assumption, there is built in there a belief that AI is going to deliver increased productivity growth and within the next 5 years. I think that was giving them 0.2 percentage points of productivity growth. It's a risky assumption to make. It is plausible, but it is equally plausible that that doesn't happen and that they may then have to revise their assumption on that one. The other thing which struck me that was very optimistic about their forecast was they are expecting unemployment to fall over the forecast from the 5% that it is currently back down to 4%. Now, we did a little bit of work, again, reported in our November outlook, suggesting that we believe that the natural rate of unemployment, or equilibrium, if you like, is around about the 5% that it is now. So we would be very surprised if we saw unemployment falling that dramatically, as in the OBR's forecast.
Very interesting. And I guess that will be true of almost all of the things that feed into the OBR forecast. Even tiny changes to those numbers, if they accumulate over 5 or 10 years, certainly, or even 5 years, they will already start building a wedge between what was expected now and what might be coming in actually in 29-30. So there are risks on that front as well. That's been a very interesting discussion around some of the key outlooks in the budget, and we'll no doubt come back to some of the specific measures and also additional things that the government could have done. But I want to move on to Mo from the CBI. Businesses are very much at the heart of investment, of innovation, of growth, and indeed employment in the UK economy. And from what I can tell, out of the 75 new policy measures, there weren't all that many that were targeted at growth. So what it would be lovely to hear, Mo, is from your perspective, how you at the CBI have assessed the impact of this budget, but also what your members might be saying and how the business community in general is reacting.
Thanks, Tera. Very happy to talk a little bit about some of those. I think, in our press release yesterday, we said very clearly that this was a missed opportunity for the government to deliver on its growth mission. And while, as you say, not many of those measures that government introduced were aimed at business, those that were, and I think I sort of challenge Katharine's point a little bit that they weren't anti-growth. We think they were. We think, our members in particular think cost of doing business is likely to go up as a result. And I'll come on to talk about some of those measures. But also business investment is likely to be lower where it would have been otherwise because of government intervention, partly because they increase costs and reduce profitability. The other point that's also worth saying is just on the timing of the budget. And again, sort of two reasons. One is, I think today is Black Friday, and you've got the holiday season for many retailers. Like, they have said to us over the lead up to this that the timing of the budget and just the amount of speculation and interest that the budget has had this time around has been really damaging to what would be their busiest period in Q4. Coupled with that is that many businesses will get their business rates revaluations that come into effect in April next year. And so there have been so many smaller, more administrative issues that businesses have had to face as a result of this budget that I think we shouldn't overlook either, just because of the timing. The third thing I'll say before I get into the measures is just taking a step back, and the way that we evaluated the budget was not to look at it compared with what we saw this time last year, which was a terrible budget for business, but actually look at it from the lens of government saying that their single focus is on the growth mission and trying to evaluate it against that. And when we look at it through that lens, I genuinely don't think there is that much on delivery of the growth mission, right? So we had a couple of areas where we were positive about. The commitment to maintaining capital spend by government is key. I think it's often one of the easiest areas to cut, and we were positive on that. Hiring additional planning officers, again, practically will and should help improve infrastructure delivery and clear the backlog of planning applications at the local authority level. Providing some additional tax incentives to startups and scale-ups removing some of the limits on EIS, VCT, and EMI, I think will, venture capital trusts, enterprise investment schemes, and so on, should help unlock some startup capital and improve access to finance and talent. And the additional, the 725 million that they've committed to the growth and skills levy to fully fund SME apprenticeships. So there was some good stuff in there for younger people. The other side of the ledger, and what we didn't think was good, the top sort of measure I think I'd spell out is still, and I know it comes into effect April 2029, is adding NICs to salary sacrifice. I think it's still a terrible policy, not just because it has additional costs to employers. 3/4 of our members that we surveyed said that they wouldn't be able to increase pension contributions, and so effectively it's a reduction in pension savings for employees. It comes at that critical time that the Pensions Commission is running, and so it just didn't make any sense to us to implement this just to raise another 4 billion. And it effectively is a tax on doing the right thing, right, on saving for retirement. The second was there was nothing in there on addressing energy costs. We have some of the highest energy costs in the world. And apart from the British Industrial Competitiveness Scheme, which Peter Kyle, the Secretary of State for Business, announced at our annual conference on Monday, we've not seen anything else. That policy helps about 7,000 of the most energy intensive businesses. But beyond that, there is nothing to help other businesses. And like I say, our energy costs are about 4 times what they are in the US. The increase in national living wage comes off the back of massive increases in national living wage this time last year. So we had it 4.1% this year. Again, because of the timing, it comes in very quickly in April 2026. And it adds to a lot of the costs. So if you think about, for example, in hospitality, they will have increases in business rates, in particular like hotels. They'll have the tourism tax, and then they'll have this layered on as well. So it's really difficult for a low profitability sector like hospitality. There was no clear roadmap for public-private partnerships. Again, another area that we've advocated for. We want to see successors to PFIs, which have a bad name, but we want to see lessons learned from that and new measures. And we've only heard about the NHS Rebuild program and getting hospitals built using public-private partnerships, but we want to see that broadened out. And the last area was around adult skills that just felt totally lacking. So like I said, younger people, those under 25, some money put behind supporting their skills, but nothing on lifelong learning and adult skills. And I'll just end on, we do a snap survey of members, and I took the results just before this webinar just to go over them and to be able to share at least a little bit of what members have said. And broadly, when we asked them about how they thought the budget went, like broadly neutral, sort of 10% of respondents were positive, about 20% were negative, but mostly in the middle. But then we got into asking them about questions like, did the Chancellor strike the right balance between addressing fiscal pressures and delivering a pro-growth budget? And only 18% actually, only 60% disagreed with that statement. So it's quite high. Do the announcements help tackle delivery barriers? Only 1 in 5 said that it does. Does this budget help lower the cost of doing business? Net balance of 80% negative. So again, just trying to get across that point that even within the sort of 24 hours this budget's been open, we've had really clear sentiment shared from government on this. And the last one, 36% net negative results on, does this budget give you greater confidence to invest and scale in the UK? That's what we've been hearing from members. So maybe I'll stop there. I know I've ended up being sort of a bit more negative than others, but like I've talked about the good stuff that that businesses have welcomed and that we've welcomed, but there is a lot on the other side that I think this is a budget for stability, but not for growth. And I just think that's what the business sentiment has shared. And the last thing in the EFO, I mean, this, I think, Katharine, you mentioned this line around, we've assessed that none of the policy measures in this budget have a sufficiently material impact to justify adjusting our post measures potential output. I mean, I think that just says it all. I should have just started and ended with that, but I think that does say it all, and that's probably the business view in a nutshell.
Thank you, Mo, for that really comprehensive run through of the various policies and the fact that there probably are a couple of policies, albeit small and very, very targeted, that should help either in terms of, younger people joining the workforce and staying in it, or indeed getting that infrastructure stuff built on time, et cetera, et cetera. But but there are also measures on the other front. And it's interesting, you've all kind of identified this potential conflict between quite a lot of the measures potentially hitting cost of employing people and therefore potentially having a negative impact on employment. And yet, the OBR's employment assumptions being quite positive. And so it remains an area of uncertainty and risk, I presume, in further fiscal forecasts and in further fiscal events.
Tara, can I just add to that very briefly? I think the OBR didn't take a call on the employment rights bill, but we know that will have a much bigger impact than most of these measures on the cost of hiring and on the willingness of employers to take a risk on taking on people who have either been economically inactive, long-term sick, or younger people. And that's a big uncertainty and risk coming down the line. But I don't believe the OBR this time has scored it because there's insufficient details about the policy measure as a whole. But that's the one area that we are. It's probably the top concern alongside energy costs for members is that, and I think once the OBR does take that into account, their forecast on employment could change. It could change significantly.
That's a really important additional point. I think there's always a bit of a disconnect, isn't there, between policies that get announced outside of the budget and then what gets scored when and how. I should say one positive thing, by the way, which is there's a whole box in the OBR report about how they are improving how they score the supply side policies, if any. And as you've just stated, this time round, they literally say there weren't any that were above their materiality threshold. But one of the things that they are embedding into the system is they are going to require departments to provide evidence and evaluations. So if they claim that a certain policy has a positive or indeed negative supply side effect, there needs to be an evaluation so that 5 years later we can actually see whether it did or didn't create the potential output that was anticipated. And I think that kind of learning from historical evidence is critical to the credibility of the OBR, but also like the quality of the decision-making process going forward. Thank you all for fantastically interesting perspectives, and I think very complementary perspectives from business, from the markets, and then from the sort of macro modeling perspective. We do have some questions in the chat, so let's start with those. First of all, let's start with a kind of broad macro question. There's a question here about how is the UK different from Japan, or is it very different from Japan? Japan had a very long period of little growth. Actually, Yingjin, if you're there and if you're able to unmute yourself, feel free to actually ask the question yourself, please.
Thank you. You can hear me?
Yes.
Yeah. Thank you very much. Yeah, and a really helpful session. Thank you so much. And what I was saying there, like Tara was saying earlier, Japan had absolutely no growth for decades, had a much higher national debt. But Japan has just launched, if I'm not mistaken, a package to boost the economy. But why is Japan having so much fiscal room, headroom, while the UK actually has been struggling and have not been able to do anything? Thank you.
A very interesting question. I don't know, Katharine, if you have a perspective on why Japan has been able or willing or to go with that sort of approach, as opposed to the UK constantly worrying about the debt ceiling and how we possibly can't necessarily borrow and invest.
I think there's really two parts to this question. One is really about Japan and one is about the UK. I mean, first of all, I would a bit disagree with the no growth. Actually, Japan has had really decent real GDP growth for quite some time. Under Prime Minister Abe, they put through major reforms that boosted the supply side. You see huge investment in private sector capex investment, pretty decent productivity growth. You've had a significant increase in labor participation, especially amongst women. Depending on how you cut the data, actually female labor participation in Japan now is higher than in the US. That's always, kind of a fun fact to throw out there. And crucially, a lot of this debt, almost all of this debt, is held domestically. And that is where I think you have a big difference with the UK, where we rely on, foreign investors really hold, significant amounts of UK debt. And so, that's one of the reasons why we are more under the scrutiny, if you like, than say Japan, and where market forces can have more of an impact on our fiscal situation. Yeah.
Thank you, Katharine. Stephen, I wonder if NIESR has a point of view on this broad idea of, could the UK potentially just borrow more as long as the money was spent on productivity enhancing investments? Or is that not something markets would bear?
Well, I'm not sure NIESR has a view on this, so I'm just going to give you my view, which is, at the moment, the markets just simply wouldn't bear it. It's not credible. I could imagine a world where a well worked out plan around public investment that was clearly going to yield returns over a period of time, the markets would be content to lend to the government for precisely that plan. But the trouble is that at the back of everybody's mind at the minute, we still have the Liz Truss budget. And that, I think, just makes, and Katharine will know this way better than me, but I think that just makes people in the markets jumpy at the minute. I think just now is not a time when the UK government could actually do this.
Very interesting. We have another question now, more about the specific measures in the budget, by Kevin Newman around the freezing of the tax thresholds. Kevin, if you're online and are able to unmute yourself, would you like to ask your question? Okay, so I will read out Kevin's question. So obviously, by far the biggest revenue raising policy in the budget was the freezing of the tax thresholds going forward. And Kevin's questions about the risks around that. Is it risky as a policy option because the outturn could be lower revenue? And I guess it would be interesting to hear all three of your perspectives on that. I've heard a lot of the think tanks out there say it would have been better, and I think, Stephen, you've said it as well very clearly, it would have been better to raise the actual headline rate of income tax. But it would be interesting to hear your thoughts about the riskiness of that particular measure. Obviously, it depends on what inflation turns out to be or not be as we move to those outer years. Stephen, do you want to start off, and then I'll come to Mo and Katharine?
Sure. I think we can be fairly confident that this will raise quite a chunk of revenue. I think the slightly more interesting thing is the amount of revenue it raised. The risk there is not inflation, which I think the OBR have assumed inflation around target. I think the risk is, again, coming back, their assumption on unemployment. Obviously, increases in tax thresholds will matter less if people are more unemployed. But I think the main thing that makes this a bad policy, I think, and particularly from a Labour Party perspective, is that it really hits hard the poorest household. Actually, not quite the poorest, but those households in the second decile. So I think it has a very redistributive effect, which, as I said, you would expect a Labour government not to want to cause.
Thank you, Stephen. Mo, do you have a perspective on this?
I mean, don't think there's much to add to what Stephen said. I think so in early September, we'd made the intervention around making the point and almost providing some cover for government to break a manifesto pledge to increase income tax, because we thought far less distortive, sort of fairest way to raise significant sums of money, rather than go down this approach of fixing for this budget and raising a whole bunch of taxes that are, in some cases, highly uncertain, unclear how much they'll raise, and pushing them further out into the forecast period, which makes them even more uncertain. So I think that the risk is quite low on freezing tax thresholds. I think it will raise that money, but for us, I think it's the regressive nature of it that's damaging and I guess unhelpful. But I think Stephen's covered most of the other sort of points around freezing thresholds.
Thank you, Mo. Katharine, do you have a perspective on
Yeah, so economists don't like it because it's regressive. So you are putting more of a tax burden on people who can less manage it. Now, why does that matter from a macro perspective? If you think that people on lower incomes tend to consume bigger portions of that income, then if you're squeezing it, you could potentially be weighing on domestic demand precisely at a time when actually we want to maybe lift domestic demand, because we can be a little bit less reliant on growth from the rest of the world to help us through any kind of weak patch. And I think, as I mentioned before, from a markets perspective, there is evidence out there to show that fiscal consolidations tend to be less credible when they come through tax hikes than when they come through spending cuts. So again, it kind of comes back to this point: how credible is this budget really going to be? And I think there is still, this question mark for markets, and that question mark is going to cost us, right? There is going to be a value to that uncertainty, that risk in holding UK government bonds that each and every one of us, is bearing collectively, this cost.
And just to add one more thing along similar lines, of course, there is a big risk there that this change in thresholds is supposed to happen in the last year of a parliament. Are they really going to do that just ahead of an election? I mean, so there is a risk that they would go back on it for that reason, I think.
Thank you, Stephen. Actually, Katharine, if I may ask you a follow-up question on Stephen's point there. From what I've heard you say earlier, you raised that as well. You raised that as a potential risk that the markets are seeing. But equally, right at the moment, the markets seem to be buying this budget in as much as they can buy it, in the sense of not negatively reacting to it. So for now, they're sort of happy to wait and see, or is it already in the premium that was already being paid by UK government that there would be this tax raising budget, and it might not have the credibility towards the outer years that we would all wish?
My sense is that as we got closer to the date of the budget, it became a little bit more clear that this was unlikely to be a sort of compelling fiscal consolidation with spending cuts, and was more likely to be a kind of more pick and mix, or sticking plaster type budget, not dissimilar. I think we need, both governments have delivered these kinds of budgets that have been a sort of, a mix of little things here and there, sort of skirting some of the really big, difficult fiscal challenges, that NIESR has done such a great job highlighting and quantifying. None of those have really been tackled in this budget. So I think a lot of that was already, baked in, and it's not gone away. So I heard, I've been listening into lots of discussions like the one that we're having, and someone had described it, could this budget have been a one that kind of cleared the decks? And it doesn't. I don't think that this budget does that. It just sort of kicks the can a little bit down the road. It takes some immediate risks off the table, and markets sort of, are very focused on the immediate future, and the problems that are there are for another day. One thing I wanted to pick up that I thought Mo's kind of pulse survey of the members was really interesting, because one thing that I've heard, from political analysts is that whilst maybe, again, for the immediate future, this budget has done enough to kind of keep this government moving forward, that the risks are probably still very much live post-May. This is what I'm hearing from, I'm not a political analyst, but this is what I hear from them. And your pulse survey certainly resonates with that point, that part of the reason why probably we did see a kind of more of a pick and mix budget is because the government felt that they didn't have the strength, the support that they needed to kind of tackle some of these bigger issues. And so perhaps it's reflecting some weakness there.
Very interesting. We have a couple more very good questions here in the Q&A. So Andy H, if you're online and if you're able to unmute, then do you want to ask your question?
Yeah, hi, Sarah, can you hear me?
Yes.
Yeah, hi. So my question is really around where we go next. If you were the chancellor in the current situation, they're boxed in on their growth ambition by already high levels of debt, high tax burden, and by deep departmental spending cuts in the period 2010 to 2024. I remember one in particular, 60% real terms cut in the housing and communities departmental budget, according to the IFS. So how do you boost growth in any material way in those circumstances? Surely something's got to give, but what?
That is the trillion-dollar question, isn't it? I'm wondering, Mo, does the CBI, or do you have perspectives on what could have been done to boost growth? Because it is pretty clear from your membership, but also the analysis that you laid out, that there isn't very much in this budget that actively does boost growth. So what were some of those missed opportunities?
Cool. Thank you. It's a good question. I think there's a couple of areas that government could have gone further. I think that the top one is around providing more flexibility for the growth and skills levy in particular. It's a big complaint for members, larger members in particular, and businesses, that it effectively acts as a tax, because businesses pay it, but they can't use it for more modular training, or it doesn't provide that sort of flexibility that businesses need, especially given the changing nature of work right now. We had also called for measures such as Made Smarter to be rolled out more widely to all sectors of the economy and across all regions. And again, that's more to help businesses understand what technology they need and provide some of that wraparound support to actually help them make the decision on what to invest in. We had also called for, alongside the planning ask of more additional planners, to use primary legislation to push through critical national infrastructure where they are being held up by things like judicial review. And we had some recommendations on how government could help make it more attractive for businesses to list in the London Stock Exchange, so to widen and deepen capital markets around making things like pre-IPO costs tax deductible. We had done all of that knowing that it was going to be a difficult fiscal landscape. So all of those asks were fairly, I would say, cheap And that's what Treasury are really asking us to do. I think the other area is, in particular, where growth comes from. And I think this is potentially one of the upsides of providing, if sort of stability is the name of this budget, government should just say that rather than talking up growth. And I think, those messages have an impact. But I think if they achieve some of that stability, they push through with planning reforms, and they really achieve a gear shift on that, then that will start to unlock some of the issues that businesses have, and get some of that money flowing into increasing capital spending, whether that's in our grid on transmission and distribution, whether that's on data centers and AI. That could be the one area that actually is a bit of a bright spot going forward. But to me, that just feels a little bit of a risky strategy to bank it all on that. So we will have to wait and see. And the other bit that and the CBI sounds like a broken record when it comes to the Employment Rights Bill, but just having a bit of meaningful engagement to get that bill into a place that works, in particular on day one rights, would make a huge difference to both employment, but also businesses worrying about taking a chance on new people, but also just holding back money because they think that because of disputes and tribunals and so on, that they will need to hold back some of that money that would have otherwise been used on investment and capital spend, and just almost being a bit more cautious. So I think they are the areas that would help shift the dial on growth.
Thank you, Mo. And what's really interesting in what you've just said is that there are several levers out there that have nothing to do with tax and spend.
Yeah.
In other words, it's about building confidence, stability, and a narrative that's credible, and not kind of narrative over here and reality over there, which does undermine our stability and undermine investment intentions. And then a lot of the kind of more regulatory reform style stuff, which again, it doesn't cost any money in terms of budgetary fiscal headrooms and stuff like that. It's hard to deliver. I mean, all of you have been very honest about the fact that none of this is easy to deliver, but it feels like it's necessary if we want to get that growth going. Steve and Katharine, did you want to come in on this particular question around what could be done? Mo's obviously already outlined quite a lot of ideas there, but anything additional, Stephen? Stephen, we can't hear you if you are speaking. Even you look as if you're unmuted, but we still can't hear you. Yeah, unfortunately. No. Wonder if it's got to do with your microphone or something else.
Should I jump in,
Yeah,
Steve, while you
if you
try to
can,
sort it
Katharine,
out?
yeah.
So I'm not sure this really goes to the question, but one thing I thought was interesting, one of the leaks that we had in the run-up, one of the many that we had in the run-up to this budget, had to do around really reforming council tax. Now, and I thought that was really interesting, and I do wonder whether maybe we're sort of being warmed up to think about this sort of change at some point down the line. Now, the reason to mention it is, again, just purely from a sort of economic standpoint, it's much more efficient to tax fixed capital, things like housing, than it is to tax employment. Neither are perfect. They will create distortions, but you will have less distortions if you tax property versus employment. You want to make work pay. You want to incentivize people to work, to be able to retain, as much as they can of what they're earning. And property is not something that can be physically moved or around it. So, and in the UK, if you compare it especially to the US, where the taxation system, very crudely 40,000 feet. In the US, property is taxed much more relative to labor. And whereas, in Europe and in the UK, I think that ratio is sort of flipped. And just from a pure economic efficiency point of view, it would be better to tax property versus employment. So maybe this is something that future governments might think about reforming and implementing at least some elements of change going forward.
That's really interesting. And it is important. I think a lot of the commentary running up to the budget, there were a lot of people putting out papers about now is the opportunity to reform and not just tinker with the taxation system. And there are many areas of the system that are kind of ripe for reform. And that would be a way of raising the exact same amount of money, but actually in a more efficient, more growth-friendly way. And there were sort of hints at some of those kinds of things. In the little measures, in the 75 new measures that the government put in here, but they weren't reformed. They were small changes to things like, EV per mile tax is a step in the kind of right direction to make sure that we are taxing EV driving as much as we're taxing diesel and petrol cars, but it's still not a congestion charge, which is kind of, again, from an economics point of view, would be the more efficient measure to put in. I think we have time for one more question. This is a question from Mike Dixon. He's asked me to read it out because he's unable to unmute. But the question goes back to that kind of before the budget, everybody was being quite gloomy about the size of the fiscal black hole. And his question is mostly about why was it such a surprise that it came out so much smaller, given that we didn't know about the higher inflation, we didn't know about the higher wage growth, and it kind of was somewhat predictable. Was it more of a narrative thing that people liked to focus on the black hole, or was there something more fundamental in there? And then how does that relate to how OBR should be thinking about its projections in the future?
I don't know, Steve, can you jump in? I mean, I've got thoughts, but I want to give you a chance to.
Can you hear me this time? Right.
Yes.
Fantastic. I think we knew about inflation. We knew about wage growth. We knew about growth as a whole and the downward revision to that. We were kind of expecting a larger downward revision to growth, or NIESR were at any rate. And as I've mentioned, I think 3 times at least already, the OBR have, I think, a very optimistic view as to what's going to happen to unemployment. And it's indeed the fact that they have a big drop in unemployment that leads to the larger, relative to us and other observers, increase in wages that leads to a larger increase in tax take. So I think there was a surprise there. But it was hidden away. It was more on what the OBR think is going to happen to unemployment rather than the growth and inflation.
Thank you. Mo or Katharine, did you want to add to that?
I think look, I am always a little bit skeptical of sort of pitch rolling, and I think it's interesting that, as we say, when we looked at the document, even if it was published a little bit earlier than it should have been, that the size of the challenge was much smaller. In a way, it's good that the government went further to create that fiscal headroom. But I also just think, like, what was probably unhelpful is just all that speculation in the lead up. And one thing that I worry about is if we are going to get a forecast in the spring, but no assessment of the fiscal rules, are we still in the same place that we would have been otherwise, where forecasters, excellent forecasters like NIESR, end up saying that we are on track to miss, and government either feels like it has to take an action, or we have 6 months of uncertainty. But no, it's a fair question. We were quite surprised by that, the small size of the challenge relative to what we were expecting. But I'm never quite sure if that's just because of the way that's briefed out, or if that was genuinely driven by other factors.
And it sounds likely that we'll continue to have uncertainty about that particular number. I mean, it's inevitable. It's far out in the future. Tiny change now in your model changes that number a lot. Katharine, any final thoughts?
I mean, I agree with Mo. I think it was a surprise, and I think it was a surprise despite the fact that, we knew those things around inflation and wage growth. And the reason it was a surprise was because the narrative that we were hearing, in these leaks was that there was a fiscal hole. And so much so that potentially, a manifesto pledge needed to be breached. But I think secondly, and, more importantly, perhaps, is the fact that, it is a little bit of a black box how some of these OBR forecasts are being put together. It's not exactly obvious, what assumptions are going in and how sensitive they are. So it does make it very difficult as someone, who is sitting completely outside to be able to perfectly, come up and add up these numbers and work out, what does this actually mean? So I think it was a genuine surprise for most people for those two reasons.
Thank you so much. Well, we've come to the end of the hour, and all that remains for me to do is to thank everyone. First of all, thank you hugely to our three incredibly informative, interesting, and insightful panelists. I think we've had a very fascinating conversation. Thank you to all of you in the audience for joining and for asking some really, really important questions with a lot of nuance that doesn't always get discussed in media, but we were able to get into some of that in some depth. And thank you to NIESR for organizing the event. I hope you've all enjoyed it, and I hope you will join us for future events. Have a nice afternoon.
Thank you.
Thank you.
Thanks, everyone.